Imagine standing in a casino where the house always wins, but instead of fighting the house, you simply buy a share of it. For decades, a persistent illusion has dominated the financial world, convincing intelligent people that building wealth requires deciphering complex charts, predicting the unpredictable, and outsmarting armies of Wall Street analysts. We are conditioned to believe that extraordinary results demand extraordinary, exhausting effort. Yet, the most reliable engine for long-term growth completely ignores this frantic race. The truth is far more elegant, and it begins by demystifying one of the most powerful tools in modern finance. An index fund is a type of mutual fund or exchange-traded fund designed to follow certain preset rules so that it tracks a specific basket of investments rather than relying on a professional manager to pick winning stocks. Think of it as a mirror reflecting the collective performance of a specific market segment. When you purchase a single share of an index fund, you are instantly buying tiny slices of hundreds or even thousands of companies. This foundational mechanism strips away the guesswork, replacing the frantic search for a needle in a haystack by simply buying the entire haystack. This approach is the cornerstone of passive investing, a strategy that seeks to maximize returns over the long run by minimizing buying and selling. It stands in stark contrast to active management, where highly paid portfolio managers constantly trade assets in an attempt to beat the market average. The active approach sounds incredibly appealing on the surface. After all, shouldn't a team of brilliant analysts working 80-hour weeks be able to outmaneuver a static, unthinking formula? The data, however, tells a remarkably different story about outperformance and the true cost of human intervention in the markets. According to the widely respected SPIVA scorecard from S&P Dow Jones Indices, the vast majority of active fund managers fail to beat their benchmark index over a 15-year period. It is a staggering reality that nearly 90% of these highly compensated professionals underperform a basic, unmanaged market average. The reasons are mathematically straightforward. Active management carries heavy baggage in the form of high expense ratios, trading commissions, and tax inefficiencies generated by constant turnover. When you subtract these frictional costs, the presumed advantage of the expert stock picker rapidly dissolves, leaving the passive investor ahead of the pack. To understand why this happens, we must look at how these market benchmarks are constructed, often using market capitalization, which is simply the total dollar market value of a company's outstanding shares of stock. The S&P 500, arguably the most famous index in the world, weights its component companies by this exact metric. As a company grows more valuable, it automatically occupies a larger percentage of the index. You do not need a manager to decide when to allocate more capital to a thriving technology giant or a booming healthcare conglomerate. The index mathematically self-adjusts, capturing the natural upward trajectory of successful enterprises. This automatic rebalancing creates an incredibly efficient, low-maintenance wealth engine that costs a fraction of a penny on the dollar to operate, because index funds require no expensive research teams or high-frequency trading infrastructure. Their expense ratios are often near zero. Over a 30-year investing horizon, the difference between paying a 1% fee for an active fund and a 0.05% fee for an index fund can equate to hundreds of thousands of dollars remaining in your portfolio. Those retained earnings are capital that stays invested, working tirelessly on your behalf rather than lining the pockets of a financial institution. But the journey of wealth creation is never a perfectly smooth upward line, and understanding market volatility is crucial to maintaining your conviction. Volatility represents the statistical measure of the dispersion of returns for a given security or market index. Essentially, the dramatic swings between highs and lows. During periods of economic uncertainty, geopolitical tension, or unexpected global crises, even the broadest indices will experience sharp, terrifying declines. The screen turns red, financial media amplifies the panic, and the instinct to sell everything and retreat to cash becomes overwhelming. History provides a powerful antidote to this panic. Consider the devastating dot-com crash of 2000, the catastrophic global financial crisis of 2008, or the rapid unprecedented market shock of early 2020. In each of these terrifying scenarios, the broader market lost massive amounts of value, wiping out trillions of dollars in wealth in a matter of months. Yet in every single instance, the market eventually recovered and pushed to new historic highs. The relentless collective drive of human innovation and corporate profitability has consistently proven stronger than temporary economic despair. Surviving these downturns requires a structural defense mechanism known as diversification, which is the practice of spreading your investments around so that your exposure to any one type of asset is limited. By holding a broad index fund, you are inherently insulated against the catastrophic failure of any single company. If a major corporation goes bankrupt, its stock price plummets to zero, devastating the portfolios of concentrated shareholders. But within a massive index, that single failure is merely a microscopic dent, quickly offset by the growth and resilience of hundreds of other thriving companies in your basket. The self-cleansing nature of a broad market index is perhaps its most underrated feature. When a company falters, loses its competitive edge, and sees its market capitalization shrink, it naturally falls toward the bottom of the index. Eventually, if it declines enough, it is unceremoniously booted out and replaced by a rising, innovative competitor. You never have to make the agonizing decision of when to cut your losses on a dying legacy business. The index organically prunes the dead weight and continuously regenerates itself with the most vital, profitable companies of the modern era. This continuous regeneration is vital for combating the silent destroyer of wealth, which is inflation. As the cost of goods and services rises over time, the purchasing power of your cash steadily evaporates. To truly build lasting wealth, your money must grow at a rate that significantly outpaces inflation. Broad market indices, driven by companies that can raise their prices and innovate through economic shifts, have historically provided returns that comfortably exceed the inflation rate. They act as a dynamic shield, ensuring that the capital you defer today will buy you substantially more in the future. The true magic of this long-term growth is fueled by compounding interest, the process where the earnings on your investments generate their own earnings over time. It is a snowball rolling down a seemingly endless snow-covered mountain. In the early years, the growth of your index fund might seem slow, almost imperceptible. But as decades pass, the base of your wealth expands, and the returns generated on those returns become staggering. A 10% gain on a $10,000 portfolio is $1,000, but that same percentage on $1 million portfolio is a life-changing sum. Harnessing this mathematical phenomenon requires only one essential ingredient, and that is time. Time in the market consistently beats timing the market. Attempting to leap in and out of index funds based on economic forecasts is a fool's errand that usually results in missing the market's best performing days. Data consistently shows that if you miss just the 10 best days in the stock market over a 20-year period, your overall returns can be slashed in half. The passive investor simply holds on, enduring the storms to guarantee they are present for the inevitable, explosive days of recovery. This unshakable philosophy was famously validated by Warren Buffett, who issued a $1 million challenge to the hedge fund industry. He wagered that a simple S&P 500 index fund would outperform a hand-picked portfolio of elite high-fee hedge funds over a 10-year period. The results were not even close. Despite all their proprietary algorithms, insider connections, and complex trading strategies, the active managers were decisively crushed by the relentless low-cost compounding machine of the basic index. It was a profound demonstration that supreme intelligence in investing often looks like deliberate inactivity. Yet the greatest threat to an index fund investor is never the market itself, but rather their own psychology. Behavioral biases constantly tempt us to sabotage our own success. We feel the urge to tinker, to chase last year's hot sector, or to flee when the financial news cycle turns apocalyptic. The simplicity of passive investing is precisely what makes it psychologically difficult to execute during times of extreme stress. When the world feels chaotic, doing absolutely nothing feels irresponsible, even when decades of empirical data dictate that doing nothing is exactly the right move. To protect ourselves from our own destructive impulses, we rely on asset allocation, which is the strategic division of an investment portfolio among different asset categories, such as stocks, bonds, and cash. By blending a volatile stock index fund with a more stable bond index fund, you create a customized shock absorber for your wealth. When equities plummet, the fixed income portion of your portfolio often holds steady or even rises, smoothing out the violent swings. This strategic balance ensures that you have the emotional fortitude to stay invested when the market tests your resolve. The profound relief of this systematic approach is the emotional detachment it provides. You are no longer tethered to the daily ticker tape, agonizing over quarterly earnings reports or geopolitical headlines. Your wealth-building strategy operates in the background, a silent partner executing a flawless, predetermined plan. This detachment frees up your most valuable resource, which is your mental energy. Instead of obsessing over stock charts, you can focus on advancing your career, building a business, or simply enjoying your life, knowing that the structural integrity of your portfolio is sound. Of course, no financial instrument is entirely without nuance, and index funds are not immune to structural quirks. One such dynamic is tracking error, the slight divergence between the performance of the fund and the actual index it mimics, usually caused by cash drag or minor trading frictions. Additionally, in market cap-weighted indices, a handful of massive tech conglomerates can sometimes dominate the fund's performance, leading to a mild concentration of risk. However, compared to the massive fees and severe underperformance risks of active management, these are incredibly minor trade-offs for the intelligent investor. Zooming out to view the grand sweep of economic history, the resilience of broad market indices is awe-inspiring. Through world wars, oil embargoes, hyperinflation, and global pandemics, the collective output of publicly traded companies has relentlessly expanded. The index fund is not merely a financial product, it is a direct claim on human progress. When you hold a broad market fund, you're betting that tomorrow's technology will be better than today's, that businesses will find ways to operate more efficiently, and that the global economy will continue to solve complex problems for profit. To capture this progress systematically, investors often employ dollar-cost averaging, a strategy where you invest a fixed amount of money at regular intervals, regardless of what the market is doing. When prices are high, your fixed contribution buys fewer shares. When the market crashes and prices are low, that exact same contribution automatically buys more shares, essentially forcing you to buy assets on sale. This mechanical process completely removes the emotion from market entry, ensuring that you are continuously accumulating wealth without ever trying to predict the unpredictable future. Ultimately, the true power of this methodology lies in recognizing that simplicity is the ultimate sophistication. Wall Street thrives on complexity because complexity justifies exorbitant fees. The financial industry wants you to believe that you cannot navigate the markets without their expensive guidance, but the humble index fund shatters that illusion. It democratizes wealth creation, offering the exact same world-class, diversified portfolio to a young professional opening their first retirement account as it does to a billionaire institutional investor. It levels the playing field in a way few other financial innovations ever have. The transition from an anxious speculator to a confident long-term investor begins with a deliberate choice to embrace this elegant efficiency. It requires auditing your current holdings, identifying the quiet drain of high expense ratios, and systematically shifting capital toward low-cost, broad market vehicles. It means defining your financial goals, setting a rational asset allocation, and then having the profound discipline to let the market do the heavy lifting. You are no longer fighting the chaotic currents of daily price movements. You are harnessing the unstoppable underlying tide of global economic expansion. The journey of building lasting wealth does not require a crystal ball, insider information, or an appetite for reckless gambling. By understanding the profound mechanics of index funds, embracing the protective shield of diversification, and respecting the unparalleled power of compounding interest, You take absolute control of your financial destiny. Market swings will inevitably come, bringing fear and uncertainty to the unprepared. But armed with a strategic passive approach, you can view those swings not as threats, but as the very engine of your long-term growth. The market is yours to capture.